After studying this module, you shall be able to gain an insight about the capital market, primary and the secondary markets. Understand the trading process on the stock exchange, including the concept of rolling settlement and clearing the settlement cycles. Identify the current issues relating to short selling in the stock markets. Understand important concepts like circuit breakers, buying on margin. Capital market is a market for raising capital wherein the buyers and sellers are made financial securities like equity and debt instruments. Hence, it provides a channel for the transfer of funds from those who have idle resources to those who have a productive need for them. The capital market comprises two segments. The one is primary market. This market provides a platform for the issue and sale of new securities. That is why it is often referred to as the new issues market. The second one is secondary market. The secondary or stock market provides a platform for the trade of previously issued securities like stock, bonds, options and futures. Hence, it provides liquidity and marketability to the securities. Now the question is how to float new issues in the primary market. Initial public offering. IPOs are common stock offerings issued by companies that had not previously issued common stock to the public. An IPO is usually undertaken for financing new projects or expansion of company activities or for any other objective specified by the company in its offer document. Rights issue. A rights issue is a method by which a listed company can raise additional capital by inviting its existing shareholders to subscribe to newly issued shares. Therefore, instead of going to the public, the company gives its existing shareholders the right to buy shares at a discount to the prevailing market price. The price at which the new shares can be purchased is called the subscription price. A rights issue ensures that current shareholders maintain their proportionate equity interest in the company. For example, a rights issue of 1:8 means that an existing shareholder can purchase 1 share for every 8 shares held by him. Preferential issue. Preferential issue is the allotment of shares on a preferential basis to a select and pre-identified group of investors at a predetermined price. For raising funds, it may be time consuming and expensive for a company to issue securities to the public at large. In such situations, additional funds can be raised by offering securities to individuals such as directors, promoters and existing shareholders, companies and financial institutions. This method of issuing securities is known as preferential allotment. Working of the stock or secondary market. An investor willing to buy or sell shares in the stock market is first required to open a demat account and place its order with a broker who is registered with the exchange. The client is required to deposit money with the broker, after which the broker buys shares for the client. When the buy order of the share is communicated to the broker, he routes the order through his system to the stock exchange. The order stays in the queue and gets executed when the order logs on to the system within the buy limit specified to the investor. The shares purchased are then transferred by the broker to the purchaser's demat account. Similarly, when a person sells shares, he has to transfer shares to the broker's account through his demat account. Indian Stock Exchange. The Bombay Stock Exchange and National Stock Exchange are the leading stock exchanges in India. In addition, there are 22 regional stock exchanges. BSE was established in 1875 and became Asia's first and oldest stock exchange. However, in terms of the number of transactions, NSE is the third largest exchange in the world today after NASDAQ and NYSE. NSE was established in 1992 and started trading in 1994. It also became the first exchange in the world to cross the turnover of a well-established stock exchange in its own country, with BSE, in a very short period of 1 year. Stock market indices. Two prominent Indian stock market indices are Sensex and Nifty. Sensex. The Bombay Stock Exchange Sensitive Index, popularly called Sensex, was created in 1986. It shows the movement of 30 sensitive shares from specified and non-specified groups. Earlier, Sensex was computed on basis of full market cap. Since September 1, 2003, Sensex is being calculated on basis of free float market cap. Free float market capitalization takes into account only the percentage of shares that actually come into market for trading. It therefore excludes the promoter's share. Nifty 50 Index. Nifty was founded in 1995. It includes 50 shares listed on NSE and accounts for 22 sectors of the economy. It shows the price movement of 50 shares selected on basis of market cap and liquidity. Earlier, Nifty was computed on the basis of full market cap. Since June 26, 2009, Nifty is being calculated on the basis of free float market cap. Nifty 50 index is reviewed after every 6 months. Equity market. NSE started trading in the equity segment on November 3, 1994. Within a short period of time, NSE became the largest exchange in India in terms of volumes of equity trade transacted. The equity segment has witnessed rapid growth in its trading volumes. Efficient communication technology, superior computerized systems and computer literacy were some of the important reasons which contributed to NSE's growing trading volumes. Trading process. NSE was the first exchange in India to introduce a fully automated screen-based trading system called National Exchange for Automated Trading, that is NEAT. Investors can trade across the length and breadth of the country on a real-time basis. It is an anonymous order matching system in which order matching is done by the trading computer. Market orders placed by investors are automatically matched with the best limit orders. Hence, buyers and sellers remain anonymous. The advantage of such an anonymous order matching system is that it brings more transparency by displaying all buy and sell orders in the trading system. All orders in the trading system needs to be replaced through brokers, many of which provide online trading facility to retail customers. Market timings. Except Saturdays and Sundays and holidays declared by the exchange, trading takes place on all days of the week. The market timings of the equity segment are: pre-open session starts from 9 a.m. to 9:15 a.m. during the market days. This session consists of mainly 3 slots. The first one is 9 a.m. to 9:08 a.m. order collection period. During this period, orders can be placed, modified or cancelled. 9:08 a.m. to 9:12 a.m. order matching period and trade confirmation period. During this period, placed orders are confirmed based on the price identification method called equilibrium price determination or call auction. During this period, placed orders cannot be modified or cancelled. The third is 9:12 a.m. to 9:15 a.m. This is a buffer period and facilitates transition from pre-open to normal market session. Regular trading session. The regular trading session commences at 9:15 hours and closes at 15:30 hours. Then the closing session is held between 15:40 hours and 16 hours. The rolling settlement. The success of dematerialization ushered in the area of rolling settlement and also helped to shorten the settlement cycle. In a period of less than 4 years, Indian capital market could make a transition from a weekly settlement cycle to a T+5 settlement, then to a T+3 settlement and finally to a T+2 settlement. This implies that now all trades at the end of the day T have to be settled 2 working days after the trade date. For example, trades taking place on Monday are settled on Wednesday and so on. The following table shows the settlement cycle for rolling statement. In this table, we have in the first column the trading, clearing, settlement, the post-settlement and other issues. In the second column, we have the activity which can be seen along with each activity of trading, clearing, settlement, etc. Then we have the day, which is T+1 working day, T+1 working days and so on. Circuit breakers. Some factors influencing stock prices are completely unpredictable. For example, markets are deeply influenced by sentiments and herd mentality rather than logic. Market sentiments cannot be predicted accurately and their impact on stock prices is difficult to judge. Sometimes they can lead to extreme volatility in stock prices with prices moving tremendously in any direction. Such a condition is beyond the control of regulatory authorities. Hence, they use circuit breakers to curb such market situation. Circuit breaker is a system formed by SEBI to control the stock prices from moving beyond reasonable limits. This is important because when a stock enters an upper circuit, it puts an investor already holding that stock at an advantage, and when a stock enters into a lower circuit, it puts the investor in a loss position because he will now have to sell the stock at a much lower price than what he had paid for it. Therefore, circuit breakers are important to safeguard investors against major losses arising due to such volatile price fluctuations. These circuit breakers, when activated, lead to a trading halt in all equity markets nationwide. This allows the market to cool down. For example, BSE Sensex moved up by 2,110.79 points on May 18, 2009 after the parliament election results were announced. The trading had to be halted since the market became extremely volatile. Clearing and settlement. NSE has set up the National Securities Clearing Corporation, that is NSCCL, for offering settlement guarantee. Settlement is a two-way process which involves transfer of funds and securities on the settlement date. NSCCL has a panel of 13 clearing banks which include Axis Bank Limited, Bank of India, Canara Bank, Citibank, NA, HDFC Bank, Hong Kong and Shanghai Banking Corporation Limited, and ICICI Bank, IDBI Bank, IndusInd Bank, Kotak Mahindra Bank, Standard Chartered Bank, State Bank of India and Union Bank of India. Clearing accounts have to be maintained and operated by each clearing member with any of the above listed clearing banks at the designated clearing bank branches. The steps are as follows. The exchange notifies the trade details to NSCCL. Then NSCCL gives the complete trade details to the custodians. After the custodians affirm back, the net settlement obligations of the clearing members are determined. A clearing member would either have pay-in or pay-out obligation for funds and securities separately. The dues for funds and securities are determined on T+1 day. Download of obligations and pay-in advice of funds or securities. NSCCL instructs clearing banks to make funds available by pay-in time. It then instructs depositories to make securities available by pay-in time. Pay-in securities, that is NSCCL advises depository to debit pool account of custodians or CMs and credit its account, and depository does it. Pay-in of funds, NSCCL advises clearing banks to debit accounts of custodians or CMs and credit its account, and clearing banks does it. Pay out of securities, NSCCL advises depository to credit pool account of custodians or CMs and debit its account, and depository does it. Pay out of funds, NSCCL advises clearing banks to credit account of custodians or CMs and debit its account, and clearing bank does it. Depository informs custodians or CMs through depository participants. Clearing banks inform custodians or the CMs. Dealing with defaults. What if there are defaults in large numbers? There is a possibility that the NSCCL can go bankrupt. To avoid such a situation, the NSCCL has set up checks and balances to avoid large defaults. Trading exposure limits have been given to each member. based on the deposits placed with NSE and NSCCL. For example, a trader makes a deposit of rupees 10,000 and his net exposure ratio is fixed at 20 times. This implies that he can trade within an exposure limit of rupees 2 lakh. To keep a track of member position, NSCCL developed a software that would not only inform the members of their exposure positions on a real-time basis, but also stop them from trading once they cross the exposure limit granted to them. In case of default, the NSCCL, which acts as the central counterparty for the settlement process, steps in to complete the settlement. When there is a shortage of funds, the settlement guarantee fund is used to complete the settlement. When there is a shortage of securities, the NSCCL meets the shortages by either buying the required shares through the auction or borrowing the securities, which is recently permitted by SEBI. Later on, the NSCCL recovers the dues from members who are short in deliveries and also levies penalties for defaulting on payments. Margin transactions. When an investor borrows to buy shares using the shares as collateral, it is known as buying or margin. In other words, securities are bought by paying a part of the stock price called a margin and financing the balance amount through a loan. Buying on margin allows investors to make investments with their broker's money. It allows them to take positions in larger shares than they could by buying with their own money. Through leveraging, gains can be modified in good times when the stock price increases after it is purchased. However, it can also magnify losses in bad times when the stock prices fall. Not only are investors exposed to risk, brokers and lenders are also exposed to the risk of default, especially when stock prices fall. In order to mitigate such risks, brokers impose conditions called margin requirements. There are two types of margin requirements. One is initial margin and another is maintenance margin. The initial margin. Let us say the initial margin is set at 30%. This means that an investor must pay at least 30% of the securities purchase price upfront and can borrow the remaining 70% from the brokerage firm. The brokerage firm will then hold the bought securities as collateral. Consider this illustration. Assume that an investor purchased 500 shares of ITC Limited. The shares were trading at rupees 50. Now suppose the investor sold the shares for rupees 100. To determine the effect of leverage by purchasing the share on margin, calculate the return on transaction if no margin was used and 60% initial margin requirements was used, and ignore the transaction cost. Let us look at the solution. If no margin was used, the initial outlay would be equal to 500 shares multiplied by rupees 50, which would be equal to rupees 25,000. Cash inflow from sale of shares would be equal to 500 multiplied by 100, which would be equal to rupees 50,000. Therefore, the return on transactions would be equal to rupees 50,000 minus 25,000 multiplied by 100, which would be equal to 100% or 25,000. Secondly, let us consider the case of 60% initial margin requirements. Initial cash outlay would be equal to 25,000 multiplied by 60%, which would be equal to 15,000. The borrowed funds would be equal to rupees 10,000. Cash inflow from sale of shares would be equal to 500 shares multiplied by rupees 100, which would be equal to rupees 50,000. Thus, the return on transactions would be equal to rupees 50,000 minus rupees 10,000 minus rupees 15,000 multiplied by 100, which would be equal to 166.67%. As shown in this illustration, the investor was able to magnify his returns by buying stock on margin. Maintenance margin. After the initial purchase, a maintenance margin is set. A maintenance margin specifies the minimum amount of equity expressed as percentage of the total value of the margin account that must be held in the margin account at all times. If one or more securities in the account falls below a certain price, and these requirements are not met, the value of equity falls and the investor receives a margin call. In this situation, the brokerage firm requires the investor to deposit funds to bring the account back to the minimum maintenance requirement. Let us explain this with the help of an illustration. Assume that an investor had purchased 100 shares of ITC Limited. The shares were trading at Rs 60 when the transaction was executed. The initial margin requirement on account was 50% and the maintenance margin was 25%. Ignore the transaction cost. Now, if the share price falls to Rs 40, then owner's equity would be equal to market price minus loan amount, that is a safety margin, divided by market price multiplied by 100. In this case, this would be equal to 4,000 minus 3,000 multiplied by 100, which would be equal to 1,000 divided by 4,000 multiplied by 100, that is 25%. So the conclusion is that since the maintenance margin has been reached, the investor will receive a margin call if the share price of ITC Limited falls below Rs 40. The investor would either have to deposit additional funds or liquidate shares to satisfy the initial margin requirement. Short selling. Short selling is a mechanism of selling a security not owned by the seller, that is selling a borrowed security. Short selling is undertaken on the expectation that the share price will decline. A person who sells short will borrow the shares and deliver them to the clearing corporation at the pay-in time. Later, in order to return the shares to the lender, the person or the borrower will have to buy the shares from the market. Here, two situations can arise. The merits of short selling. Short selling provides a mechanism for correction of stock prices. When stock prices of a company are much higher than normal, short selling helps to bring down the prices to normal level. Hence, short selling prevents stock prices from going over the tops on over optimism and hype. It adds liquidity to the share transactions. The additional buying and selling reduces the difference between the price at which the shares can be bought and sold. The risks of short selling. Bear cartels can engage in heavy short selling to push down stock prices steeply and close out their position at a future date at much lower prices. In this way, they can make huge profits at the expense of other investors. Let us summarize what we have learned from this module. Capital market is a financial market where buyers and sellers trade equity and debt instruments. It consists of primary and secondary market. Companies use initial public offer or IPO, rights issues and preferential issues to float new issues in the market. BSE and NSE are the true prominent stock exchanges of India. A number of stock market indices are constructed in India. Out of these, most popular indices are S&P, CNX, Nifty Index and Sensex. Both these indices are calculated on free float market cap. NSE introduced a fully automated screen-based trading system. Its anonymous order matching system is one of the best in the world. Under NSE, all trades are settled on a T+2 rolling settlement basis, that is 2 working days after the trade date. Circuit breaker is a mechanism to control the stock prices from moving beyond the reasonable limits. It leads to a trade halt to cool down the market. NSE has set up wholly owned subsidiary called the National Securities Clearing Corporation or NSCCL for offering settlement guarantee. When an investor borrows to buy shares using the shares as collateral, it is known as buying on margin. There are 2 types of margin requirements, initial and maintenance. Short selling means selling a security not owned by the seller, that is selling a borrowed security. A short seller expects the stock prices to fall.